Looks like I've started the recording. All right, so looking at tests, all of the previous tests, switching to Moodle. Yeah, where's Moodle? This is it. Test number 4. A few questions in test number 4. So you might not have got all of these questions. There were some random questions selected for your test number 4. Let's go through each of these. EPS is earnings per share. So you have stock price, you have net income, you have total equity, you have sales revenue, and you have number of shares outstanding. You don't need all of this information for EPS. EPS is earnings per share. From what we've learned during this semester, you know that earnings per share is net income divided by the number of shares outstanding. Okay, so net income is 12,200,000 divided by 4 million. I'm using a calculator here, but I think Google Meets is not showing the calculator to you. Actually, I can switch to the whole screen so you can see whatever I'm using. Unpin this. Okay, and stop this. Instead, the screen. Here. Okay. So, now you can see everything. The calculator and Moodle, is that right, guys?
Professor.
Is that right? Can you see Moodle question and the calculator at the same time? No? Let's see what.
Yes, Professor.
Okay. So, yeah. So simply $3.05 earnings per share. Okay, earnings per share. Next question, equity multiplier. Again, from what we've learned, equity multiplier is total assets divided by total equity. Okay, what do we have here? Debt ratio is, debt to equity ratio is 1.3. ROA is 8%. Equity is 12 million. How much is the equity multiplier? Okay. Let's get paint over here. So, equity multiplier is total assets over total equity, right? We have total equity here, 12 million, but we don't have total assets. Instead, what we have is debt to equity ratio is 1.3. So debt is 1.3 times bigger than equity. And remember that total assets is all of the debts, total debts, plus all of the equity, right? Total equity. So debt is 1.3 times bigger than total equity. So instead of total debt, I can write down 1.3 of total equities, right? 1.3 total equity plus total equity will be 2.3 total equity. Divide by total equity, this and this cancels out. We have 2.3 as the equity multiplier. Okay? Growth. Okay, we have total assets, we have total equity, sales revenue, cost of goods sold, depreciation, admin expenses, interest expense, tax rate, and dividends. How fast is the internal growth? Okay, internal growth. Let's see. Internal growth. That's from your from our lectures. And again, you will not have to memorize the formulas because the exam is online anyway, right? but the internal growth is return on assets times the retention ratio over 1 minus return on assets times the retention ratio. Okay, so return on assets in our case is total assets over, interest expense over total assets. 14 over 2756. Let's open Excel. I think it'll be easier in Excel. And so I don't switch between screens too many times. Let me take this and put it here in Excel. Okay, so we need a return on assets. That will be equals the profits. Where are the profits? Oh, we need to calculate the profits. We don't have those. So let's see. Sales revenue, cost of goods sold. We have depreciation. We have interest expense. Then we're going to have, well, admin first. We can have EBT. We have interest expense. We have EBIT. Vice versa. Earnings before interest and tax, and earnings before tax. And then we have the tax, and we have net income. Okay, so 1,600 for, that's total equity, sorry. Sales revenue 260, cost of goods sold 114, depreciation 28, admin expenses 34. We can calculate EBIT. Let me zoom in so you can see a little bit clearer. What did we do for formulas here? We don't actually need EBIT for this question, but interest expense is 14. Earnings before tax is EBIT minus the interest expense, and tax rate is 30% of the EBT. Net income is EBT minus the tax payment. So net income is 49, whatever it is, millions or whatever. Return on assets is net income divided by total assets of 2,756. Okay, so we have 1.8% or so return on assets. Dividends is 19, so let's calculate a retention ratio. That's how much of profits we keep inside the company after paying the dividends, right? So that's equals 49 minus 19. That's how we keep inside the company over the total profits of 49. That gives us around 61.2%. Okay, and the formula for the internal growth over here, very ugly, but basically it's equal to 1 minus, oh no, that's equal to return on assets times retention ratio, all of that divided by 1 minus return on assets times the retention ratio. So the growth is around 1.1%. The growth is around 1.1%. Formula, double check the formula, ROA, yes, times the retention ratio over 1 minus ROA retention ratio. Okay, okay, next question. Similar one, but sustainable growth.
Oh, Professor,
Yes.
can I see one more time retention ratio? How did you find?
Sure. So, retention ratio plus dividend payout ratio together is equal to 1. So all of our profits, what do we do with the profits? Part of the profit we pay out as dividend, the rest is retained earnings, right? So the percentage of profits that is paid as dividend is called dividend payout ratio. And the percentage of profit that is not paid as dividends is called the retention ratio. Okay?
Okay, got it.
Right. Another question here. Same question about sustainable growth rather than internal growth. So the formula changes. We need return on equity rather than return on assets. So that's going to be net income divided by equity. Equity is 1,600. Okay, so this is the internal growth. This is the sustainable growth equals return on equity times the retention ratio divided by 1 minus. Don't forget about these brackets. If we forget about these brackets, then it just divide by 1 minus separate thing. So brackets 1 minus return on equity times the retention ratio, bam, 1.9%. Sustainable growth is almost always higher than internal growth. Sustainable growth cannot be smaller than internal growth. Some sort of a hint for you to double check if you're doing things correctly. Right, they can be equal if there is no borrowing at all, if there is no interest at all. They can be equal, but sustainable growth cannot be smaller than internal growth. Market value, market to book value, the ratio of market price of the company to the book value of its assets. So we have total equity here. Where is it? Here, total equity here, 24 million. So that's everything that is held by the owners of the company, right? Total equity. On the right-hand side of the balance sheet, we have total debt plus total equity. But the stock price is 550 NT, and there are 4 million shares outstanding. So if you just buy the whole company, that will be the market value. And this is the total value of the owners. So this ratio is the market to book value, or market to book ratio. Market to book value ratio. Anyway, so calculator is easy enough for this, I guess. 550 per share times 4 million divided by the total equity of 24 million is 91.67 is the ratio. 91.67. Okay. Net income. Okay, so again, debt to equity ratio 1.3, return on assets 8%, total equity is 12 million. How much is net income? Okay, net income is, we can find net income by looking at ROA, for example. ROA is net income divided by total assets. Let's see how much is the total assets. Total assets is debt plus equity. So debt is 30% bigger than equity. Let me get a calculator. So 12 million, I'll just count in millions, times 1.3, that's how much of debt we have, 15.6 million plus 12 million of equity. Our total assets is 27.6 million. 27.6 million. Okay, let's count in millions, multiply that by million. So 27.6 million, and 8% of this is net income according to return on assets. So times 0.08, 2,208,000 for net income. Okay. Price earnings ratio, PE ratio, is the ratio of stock price to earnings per share, EPS. We looked at earnings per share at the beginning right now. So stock price is 550. Earnings per share, we've just seen it like 10 minutes ago. That's net income. Where is it? Net income is here. Divided by the number of shares outstanding. So let's see, that's 12 million, 12.2 million divided by 4 million. Earnings per share is $3.05. The share price is 550. 550 divided by $3.05. The PE ratio, or price earnings ratio, is over 180.33. Over 180.32. Okay. And the last question for test 4, return on equity. Okay, so in one of the recent questions we've calculated net income. How much was that? I already forgot. We're going to do it again, I guess. So 12 million times 1.3, that's the debts, plus 12 million, that's total assets, times 0.008. This in millions is the net income. And we want to divide that by total equity to find the return on equity. Divide by 12, that's all in millions. So the answer here is 18.4% return on equity. Okay. That's test 4, test 5. Okay, someone deposited 10,000 for you 15 years ago. Interest rate is 4% per year. You're gonna withdraw funds 3 years from now. How much money will be available to you? I thought somebody was joining here. Okay, how much money will be available to you? So which variable do we have to calculate? Is it PV? How do you guys think? How much money will be available to you? Is it PV?
FV?
It's FV, yes, very good, it's FV. So equals FV, the rate, 4%. Number of periods, this is the tricky part. So somebody deposited 15 years ago for you, plus that's already today now, 15 years already passed, and you still wait for another 3 years before you withdraw. So altogether the investment has 18 years. No regular payments, somebody just put the money there and they sit there for 18 years. We don't have any information of adding or withdrawing anything regularly. So nothing, and the PV is 10,000 negative, because that was cash outflow for someone, and 3 years later you'll have more than 20,000, this amount, 20,258.17. Okay, again, same question. Same question, different numbers, so we skip that. Same question, different numbers. Another question. Somebody's outside with the microphone turned on. If you have a chance, turn off the microphone. So, a bond promises to pay you 100,000 5 years later. Interest rate is 2%. How much are you happy enough to pay right now for the bond? What do we have to calculate?
The PV.
Yes, PV. The most difficult part of the exam is understanding the question. Okay, once you know that, open the brackets, you get all the hints. 2%, 5 years later. PMT, regular payments. Does the bond pay any coupon? And if there's any information about coupon payments, that's the regular payments. We don't have anything about that. So just 0, and at the future date, when the bond expires, gives me 100,000. Is that 100,000? Yes, 100,000. So right now, the price of the bond is 90,538.08. And other questions are the same, just different numbers. Just plug different numbers. Just plug 200,000 and 3 years, 3%. So that's test number 5. Test number 6. Okay, so you have 2 investment options for your cash of 4 million. One is to give your money to a friend at 5% simple return, simple rate for 4 years. Or put your money in your account, 4% but compound, regular interest rate. Okay. Calculate how much equivalent compound rate would your loan to your friend earn. So in reality, you don't charge your friend interest on interest. It's just too complicated, and you are friends and he's a reliable friend. So you just make it simple, 5% simple rate per year. But if it's, so with this loan, if you do give your money to your friend, you will earn something, right? So if this amount that you earn was instead earned on a regular compound rate, how much would that equivalent compound rate be? That's the question. Okay, so we don't even actually need the second part of this option, investment option. So the formula that you have to calculate, you only have 5. Which of these 5 do we want to calculate?
Interest.
Yes, interest rate. So that's a rate. So equals rate, open the brackets. Number of periods would give for 4 years. So 4. Wait. For PMT, no regular payments, just nothing about regular payments here. So 0. How much is invested? 4 million, -4. In future, how much do we get? We got to calculate that. We haven't got that from the like direct numbers, but we got to calculate that. Okay, so how much am I gonna get is 4 million. I'm gonna get back 4 million plus I'm gonna get 5% of 4 million. Actually, let me make it separate so that the formula doesn't get too tricky. Turn it into a text for now. Okay, so how much will my friend give me back 4 years later? Well, every year I'm going to get 5% on the 4 million, so 5% times 4 million is 200,000. 5 times equals this times 5. Total interest is going to be 1 million plus the original 4 million. He's going to give me back 5 million at the end of 5 years. At the end of 4 years. Oh, so it's not 5 times, it's 4 times of the 200,000. So anyway, this equals the original 4 million plus whatever is the interest, 4.8 million. So now we can go back to this formula. The future value here, in future, how much will I get back? This is going to be 4.8 million. Okay, bam. So this might not be correct if there are too many approximations here. And it's not correct. 4.66 is not the same as 5. Okay, so the answer is 4.66. Next question. 10 years ago, your relatives invested $1 million into your name. That investment expires today. The interest rate has been 2%. Additionally, you have another 5 million already in cash. If you invest all your available funds at 3% interest rate, how long do you have to wait to be able to buy an apartment for 8 million? Wow, this is a very interesting question because a lot is going on. It's very interesting. So when you see this kind of question, it's a really good idea to put things on a timeline so you understand what's happening. It's going to make it easy for you to understand what's happening. That's the most important part. Everything else the computer will help you with. So let's see what we have. Again, where was it? 10 years ago, right? So 10 years ago, and this is today. And when do you want to buy an apartment? How long? I see. How long will we need to wait? So sometime in the future, we want to have 8 million. Right? We want to have 8 million sometime in the future. That's probably going to be our FV value. Okay. What do we have right now? We have 5 million in cash. So you already got 5 million in cash. And the investment by your relatives in your name of 1 million 10 years ago expires today as well. So you get that money as well today. Here, expires today. So many years ago, they invested 1 million in your name at the interest rate of 2%. Okay. So that money is going to grow into something by now, right? So by now that money is going to grow into something, and you'll have that money plus the 5 million. Okay, so how much that money grows into, what do I need to calculate that? Is it PV, FV, NPR, or rate, or PMT?
PV.
Okay, very interesting. So, yes, presently, I want to find out how much money I have after today, presently, I withdraw the money of the older investment. But some questions can be tricky, even though the name is PV, present value, and the present is today. Actually, the meaning of PV is the amount at the beginning of the investment period, and FV is the amount at the end of the investment period, whether it's today or whatever, right? So over here we have two parts to the question. Yes, presently I'm going to invest something to get up to 8 million in the future. So for this new investment, it's going to be PV, yes. But I'm not ready for that yet. First, I'm going to look at this older investment. And for the older investment, the PV is the starting period amount. PV is here. I want to find out how much will be the amount at the end of the older investment life. That's actually FV. So equals FV at 2% and 10 years, because it was 10 years ago. No regular payments. The present value, remember, present value is the value at the beginning of the investment period. That's 1 million. Negative 1 million. So that 1 million grew into 1.2 million by now. I get it today, plus 5 million. Now looking at this second investment, this becomes PV. And I need to get to the FV of 8%. How long I need to wait? How long I need to wait? What kind of question is it? What do I need to calculate? Anyone? How long I need?
PER.
Yes, number of periods, NPR. Open the brackets, we get the hints. So the rates, go back to Moodle, we invest at 3% interest rate here. No regular payments, nothing about that, so zeros. Presently, we're going to invest negative this and negative this. Okay. In the future, we want to have 8 million. How long will it take us? It's going to take us 8.5 years. Okay. Now, if I accidentally made a mistake with negatives, we want to add these two numbers because I have both of these now in cash. I withdrew this green amount today. I can just double check that equals this plus this. In this formula, for the PV, you see the PV is highlighted in bold over here. I have this number, but because it's going to be cash outflow out of my pocket, I just make it negative. Same. I need to wait for more than 8.5 years. So the question here, as you see, how long in years? So they just leave it as it is in years. You don't need to convert that into a number of months. Not like 8 months, 8 years, and like 7 months or something. Don't need to do that. How much to have after 4 years? How much will you have at your account after 4 years? That's FV. So a friend is asking for 2.5 million with simple interest rate of 3% for 5 years. But instead you deposited 2.5 million into a savings account that pays 3.8% interest rate per year. How much will you have 4 years later? That should be FV equals FV, open the brackets, 3.8%. You invested for how long? Instead, you deposited 2.5 million into a savings account after 4 years. So 4 years, nothing about the regular payments, and you invested 2.5 million. So that's over 2.9 million here. Interest rate, clearly the formula is rate equals rate. So 2 years ago, you lent 100,000 to a friend for 4 years at 2%. You also have cash of 400,000. 2 years later, you want to buy a car for 600,000. At what rate do you need to invest to have enough money for the car? Okay, so 2 years ago, you lent your money to your friend. That was 100,000, and you lent at 2%, also 2% here. So that's going to continue growing until you buy a car, which is 2 years later, right? So this is going to continue growing until you buy a car 2 years later. Okay, so this is today, this is 2 years later. Okay, and you also have cash now, 400,000, which you also invest to buy a car of 600,000 in value. That will be the future value 2 years later, right? How much rate do you need to earn here on your second investment to have enough money here? So firstly, let's see how much your first investment will generate so that we know how much you still need to generate. Okay, so this 100,000 will grow into the future value of at 2% and 4 years, because 2 and 2, nothing for PMT, negative 100,000 is going to grow into 108,000, and you need 600,000. So after you subtract the friend's money, you will still need these arrows are taking a lot of space, so you will still need equals 100,000 minus 100, 600. Anyway, you'll still need this much. That will become your future value for your second investment, and the rate that you have to invest at is going to be equal to, you're going to invest for 2 years here, no regular payments. Presently, you're going to invest negative 100,000, and in future you will need this amount. To have enough for the car, you will need to invest at 10.88%. 10.88%. And the last test, future value. Let's see. You start now with a deposit of 50,000 and deposit 600 every month. Rate is 2.4%. APR, but there are monthly investments here. How much will you have 3 years later? So 3 years later equals FV, open the brackets. The rate is 2.4% divided by 12, because 2.4% is annual percentage rate, APR. Match everything with the smallest payments per month. Number of periods is 3 years, so 3 times 12, all in months, apples with apples. PMT, regular payments are the 600. It's going to be negative because it's going to be your cash outflow, and PV is negative 50,000. By the end of 3 years, you will have 76,102.33. Wait, where was I? Similar question here, different numbers. How long are we going to wait? That will be NPR. You borrow 10,000 at 8%. Monthly repayments to the bank are 313. How long will it take you to repay the debt? So equals NPER, open the brackets. The rate is 8%. The regular payments are negative 313. Presently, you received 10,000 from the bank, so that's a positive number for you. Future value 0. How long does it take to repay the loan? It takes what's wrong? PMT. 10,000. Okay, 8% of 10,000 is 800. 8% of 10,000 is 800. Oh, the monthly payments are 313, not annual payments. So we need to match everything with months. Okay, we need to match everything with months, with the smallest periods. So 8% divided by 12, this is monthly interest rate. Okay, then everything else is fine over here. Enter. It will take you 36 months, over 36 months to repay the debt. Present value. Investment promises 1,300 next year, this much the year after that, this much year after that, this much year after that. Oh no, 6 years later, interest rate is 4.3%. How much is the price of the investment today?
Sorry, Professor.
Yes.
Can I ask a question
Of course.
from a last question?
Sure.
Because you didn't mention that you want monthly or annually in a
see.
quarter.
Okay.
So when we are in a TED, we don't know, should we use monthly or use yearly?
I see. That's a good point. So generally, just the answer that you have for the formulas, that's the number that I'm looking at. So for example, in the previous question, when we calculated NPR, we had somewhere over here, we had I missed that. I don't know why I don't have that. We had 8.5 years. There, the formula, we didn't need to come down to the months, so we calculated everything in years, okay? So I just don't need to take an extra step to convert 8.5 years to 8 months and 8 years and 7 months. Don't need to do that. So similarly here, if the correct way for the formula is to step down to the months, and the answer is 36.04 months, then just leave it as it is, 36.04. Okay? But I will try to remember that, and I will try to make sure that it's clear enough in the questions. I'll try to remember
Yes,
that.
because we still can let 313 plus or multiply 12 to be the yearly payment, you know. So the answer could be yearly as well.
Oh, but that would not be correct. That would not count interest on interest. So in order not to lose interest on interest, we always need to step down to the shortest period.
Okay, got it.
Yeah. Good question. Always need to remember to step down to the shortest period. Okay. So here with this question, are you looking at the question? Yes. With this sort of question where all the numbers are quite different, there is no regular payment and everything, so you need to do them one by one, that's all. Okay, you just gotta do them one by one. So looking at this, so 1 year later, and you have 2 years later, 3 years later, because it says year after that, the year after that. So then 6 years from now is 5,000. So 4, 5, 6. Okay, so you have 1 year later is 1,300, 2 years later is 1,600, 3 years later is 2,000, and then 6 years later is 5,000. These are all like irregular payments. In this case, you need to do the discounting one by one, okay, to find the price today. That's PV. The interest rate is 4.3%. 4.3%. Okay, so the PV of the total investment is going to be PV of this amount plus PV of this amount plus PV of this amount plus PV of this amount. Okay, so equals, let's say, PV, open the brackets, at this rate, and this number of periods, no PMTs, and no FVs. The FV is this amount. How much is the PV? It's actually this. I can copy that. And of course, I can add them all together. As I said, the total PV of the investment is going to be PV of this plus PV of this, which is this plus PV of this, which is this plus PV of this, which is this, altogether over 8,000. Altogether over 8,000. Okay. Okay. Similar question with different numbers. You need to do them one by one with all those different kind of irregular numbers. Now you're borrowing 1.2 million to buy a car. You repay the debt in monthly payments of 28,800 over the next 4 years. How much is the interest rate that the bank charges you? So recently we had a question about these repayments of the loan in 36 months. There we had the interest rate, and the question was, how long does it take us to repay? Now we have the period. The question is, what is the rate we are charged? We repay in 4 years, but we make monthly payments. So number of periods is 4 times 12. We repay in regular payments of 28,800, so PMT is the regular payment, negative 28,800. In the present, we got 1.2 million. That's positive 1.2 million because we got it. And in future, hopefully, we'll not owe anything else to the bank, 0. The monthly rate is less than 0.6% per month. Per month. Okay, but over here I don't specify. Do we want the monthly rate or the annual rate? Okay, as I've just told you in the lecture, the industry standard, right? The law in many countries, probably all countries of the world, because there are so many different kinds of interest rates, and because not everybody studies finance, so that Yeye and Nainai don't get confused when they hear any kind of advertisements about credit card rates or loan rates, deposit rates. The industry standard is always APY, or the same thing as APR, annual percentage yield or annual percentage rate. So it's annual. So whenever we ask about interest rates, we need to remember to convert to the annual, okay? This is monthly because, remember, we stepped down to the shortest period, which was the month. Then in that case, APR is equal to this times 12. The answer over here is 7.11%, okay? So, who was it? I think it was Han, right? Ask the question. Right? What do we do here? Convert months to the years, convert years to the months, whatever. Just leave it as it is for the NPR. But for the interest rate, we always, according to the industry standard, the law in most countries of the world, need to report the interest rate in annual percentage rates. Okay? Remember that. So it's a very easy mistake to forget about during the exam. So make a note of that. Okay? And last question is same as the previous one with different numbers. Right. Stop presenting. Pin this. I think you're now ready for your exam. Questions?
Professor, can you show change the model that we can see the answer of the previous quiz? Because now we can just see that please check the topic of something like that. Actually, we can't see the actual answer of us.
Yeah, I gave you the answers, right?
Yeah, actually, because throughout this meeting, you just explained the answer of some relevant question.
Yep.
But actually, that we have different question in each test.
Yes, you have different questions in each test. So there is like a big set of questions.
Yes.
And what happens in your test is you get random questions from this set. So yes, all of you have different questions, but what I've done is I've gone through all of the questions that all of you might have. So now, if you review this video, you will have all of the answers, because I showed you the answers in numbers as well, to all of the questions you might have, instead of only your particular questions. I think it's even better.
Yeah, actually, that you're right, because we even though we know the answer, how to answer this question, but actually we just want to check the answer again. Is it
You can review the video.
Yes.
You can review the video, same as the first 3 tests. So I've also posted the videos to the questions of the first 3 tests, right? On Moodle, they're already posted.
Yeah, the answer of the from test 1 to test 3, we have the actual answer, but from the test 4 to test 7, we don't have the particular answer for us.
Yeah, we have over here. So all of I'm not showing, yes. Let me go back to entire screen like this. If I switch back. So looking at any of these questions that we've looked at, there are all of the answers here. So if you review the video again, you will have to do that if you prepare for the exam. As I talk through this complicated example, I explain, as you say, yes, you are correct. I explain, and I show you the exact answer as well. All of the exact answers are here as well. For example, for this particular question, the exact answer is 10.88 over here. So all of the exact answers are also shown over the last half an hour. Okay?
Professor,
Yep.
as I understand, midterm exam will be, we have to download Excel file and we
Yes.
need to work on that.
That's right.
And is it possible to write an answer in the paper and take a picture, submit together?
No.
Oh.
You will have to enter your answers inside the Excel file you download. So inside the Excel file, it will have a question like this. So let's say, for example, problem number 2, and there is a description like sales revenue, income statement, whatever, and then there are a couple of questions. Let's say, how much is like how long to wait, something, and like how much is something, and you will have like your answer supposed to be here, and you will have some other parts for my grading later on. So it will show points, like this question, for example, has 10 points, the actual grade will be empty, and you'll have particular space where you'll have to enter your answers into the yellow cells. So you just need to put your answers only right here, nowhere else, not on the pictures to take, not on the papers to take the pictures of, to send me by email. Those are not accepted. So you will have questions presented in this format on the Excel file. And you can use any of the space over here to do all of your calculations, any calculations that you want. If you want, you can do your calculations on paper. That's fine. You can use a calculator and paper to do your calculations, but all of your answers must be in the yellow cells. Okay? So even if you do your calculations over here, everything is absolutely right. And this part over here, SDL, is your correct answer. So the answer is there, but you didn't put it here. You will not get the points for answering this question correctly. Okay?
Okay.
So this is exactly how the exam will look like. You'll have a question and you'll have particular space to put your answers in. So your answer should be right here, like that. Okay. Did I?
No.
I didn't show anything, right? I'm
Yeah.
sorry. I'm sorry. Let's go back to that. Do you see the Excel in front of you? Yeah. So you'll have a problem, say problem 2, description like sales revenue, COGS, something. You need to calculate something here. You need to calculate something here. Let's say a couple of examples for problem 2. And you'll have a particular space for your answers in the yellow cells, please, not anywhere else. The rest of the sheet, anywhere you can do your calculations. Anything you do is fine. If you want, you can do your calculations on paper, it's fine, but you need to put your answers in the yellow cells. So even if you have your answer here, for example, this SDL, so let's say, for example, let's put it as a number. This 6143 is your correct answer, but you don't put it here, you don't get the points, okay? So in this case, your answers should be exactly where they are, okay? Doesn't matter whether you do calculations in the Excel sheet or you do them on your own piece of paper, you need to put your answers into the yellow cells, okay? Like this. This is how the exam will look. This is how the exams will look like, okay? All right.
When you're able to upload these videos, you need to upload 3 videos in total, right?
That's right, yes.
When you can upload, because actually, to be honest, I'm struggling to input that formula into the Excel sheet. It's a bit tricky. If you just make mistake just one single
Yes.
number to
If you
input,
make a small mistake, the answer is completely wrong, so you gotta be very careful.
Yeah, and honestly, I just want to watch the video again. And
Yep.
could you please upload as soon as possible,
Yes,
especially
I will try to
before
do it.
Thursday?
Yes, I'll try to do it as soon as possible. I'll try to do it today, but
Okay.
we'll
When
see
you
how it goes,
upload-
because each of these videos is very long. It will take a very long time to upload it to the internet.
Yeah, I understand. When you upload these 3 videos, could you please upload that Excel sheet you used today? I mean, the main thing is seeing that formula that you used and try to imitate.
Maybe not. The exam will be too easy. You will have basically the
Okay.
formula is written down with my hands.
Okay. Okay, I got it. But seriously, I'm asking just the 3 videos. The
For
3
sure, yes.
recording.
Yes, I'll try to do that as quickly as it will happen. So hopefully today, maybe tomorrow.
Thank you.
More questions about the exam?
Actually, I want to add a question related to the lecture.
Mm-hmm.
That I confused at the term that the difference between the market price and stock price. That I remember you mentioned in the quiz, but I confused at the how can I know the difference of that? Can you explain?
Yes, maybe you are talking about the market to book ratio. Is that right?
Yes.
So, yes. So the book ratio, the book is referring to all of the financial statements. If you look at the accountant, they will have a lot of books of balance sheets and income statements and those sort of things. So those are kind of colloquially, like in simple words, are called the books. So the book value of the company is the total equity over there. And the market value is on the real market. If you try to buy the company, you will have to buy the company shares. You'll have to buy the company stocks. So the share price, stock price is the same thing. In that example, it was 550 NT per stock, per share. And the company had 4 million shares outstanding. So if you buy the whole company, you need to buy 4 million shares each at the price of 550 NT. So that will give us a market value. But if you look at the books of the accountants, the book value of total equity is different. And that's the difference between the market value and the like accounting value for the company. If the company bought some land in the past 10 years ago, the land 10 years ago was much cheaper. So according to the accountants in the books, the value that the company is still holding is very little. By now, the price of that land has increased quite a lot. So the market value of the company will be very different from what's in the books.
Okay, I understand. Thank you.
Right? Anything else?
And actually, another term that you mentioned the due point, but and a lot of formula, but I don't understand what the meaning of Dupont.
What's the meaning of the formula?
The Dupont, because you mentioned the name of
I
that.
see. The DuPont formula helps us to figure out where is the problem with the profitability. Okay, so let me open that formula because
Professor, the
yes.
call is about to end.
Oh, the call is about to end. So does it show how many minutes do we have?
No, it will
It's
end
under the minute.
Under a minute. Oh my god. DuPont formula. Where